Hello and welcome. We're here today to discuss how to report solo 401k contributions on your tax return. We want to specifically talk about how to report solo 401k contributions on an 1120S. So a tax return for a business taxed as an S corporation. Could be an LLC taxed as an S corporation or a corporation taxed as an S corporation. So we're excited to discuss the topic. If you have additional questions or topics you want to discuss, we love to discuss these topics. So please chat over the questions, the topics. We're happy to go over those topics as well. If you find this video helpful, please subscribe on our YouTube channel as it helps us get the word out. Please like the video as well. Please feel free to share it with those that you think might be interested. We go live twice a day. This is our afternoon session. We were here earlier today. At 10 a.m. Pacific, 1 p.m. Eastern. And today, again, we're here to discuss how to report solo 401k contributions on your tax return. So obviously the ability to make contributions is one of the top reasons that customers will set up accounts with us. So the key, though, of course, is the mechanics are going to be how to report those contributions. So let's dive into it. Now we've got some slides. Of course, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. If you have any tax, legal, or investment questions, please, of course, we would refer you to your tax attorney, your financial professional. So we've got specific slides we want to go over that go over exactly how to report those contributions. So let's pull those up here and we'll start to go through it. So a solo 401k does have the highest contribution limits for any defined contribution plan available to self-employed individuals. On top of that, with our plan, you can not only make pre-tax contributions, which will reduce your taxable income, but for the year for which you make the contribution, but you can also make Roth contributions, as well as mega backdoor Roth contributions, where you've got that potential for tax-free growth. So we want to talk about how to report all those different types of contributions on the S corporation tax return. So for business taxes and S corporation. So we've actually got some great pages on our website specifically dedicated to a business taxes and S corporation. So let's pull up one of those pages. All right, so here we go. We can see we got our landmark page here at mysolo401k.net, calculating my solo 401k contributions for a corporation. You can click here on the slides. We had a deep dive webinar on this topic. So, and then if you go down to, let's see, it's around slide 40. We've got all the details about how to report contributions on your tax return for a business taxed as an S corporation. So how one reports contributions is going to depend on the type of contributions that you're making. As I was mentioning, a solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. And part of that is because, or I should say the reason for that is because the reason that you can contribute so much is because you're able to fill up different buckets. For example, one can make both employee as well as employer contributions, right? In the words of the IRS, the self-employed individual whose business sponsors the solo 401k is both the employee and the employer. So you can make both types of contributions. In addition, if you have a plan like ours, it allows for not only pre-tax as well as Roth and voluntary after tax, then those are additional buckets that the individual can fill up as they see fit. So the type of contribution that the individual is making will dictate how to report the contribution on the tax return. So for example, if the individual is making a pre-tax employee contribution, that's going to reduce their self-employment income, right? So it's made on a pre-tax basis. It reduces the income for the year of the contribution. Now, for a business tax as an S corporation, self-employment income is the W-2 wages that the individual receives from their business taxes and S corporation. So it's going to reduce the income that's reported on their W-2. Specifically, it reduces the income reported in box 1 of the W-2. So for example, if somebody makes a $23,000 contribution for 2024 as a pre-tax employee contribution, and let's say that their W-2 wages from their self-employed business is $100,000, box 1 of their W-2 is going to be reduced by that $23,000. So it's going to be $77,000. And then that $23,000 pre-tax employee contribution will instead be reported over in box 12 using code D. And then the individual will want to check the retirement plan field in box 13, or whoever's preparing their W-2. Now, let's say instead of making a pre-tax employee contribution, the individual wants to make a Roth employee contribution. So a Roth contribution is made on an after-tax basis. In that case, their income is not being reduced. So box 1 is not reduced. So it would still be $100,000 in that scenario. And instead, it's going to be reported over in box 12 of the W-2, but now using a different code, using code AA, and still checking retirement plan field in box 13. So now let's talk about employer contributions and how those are reported. And then we'll talk about voluntary after-tax contributions. So for a business taxed as an S corporation, the answer to the question of how do I report solo 401k contributions, and we're talking about employer contributions, is that those contributions are reported on the S corporation tax return. So employer contributions are not reported on the W-2. Instead, they're reported on the employer's return. So it's not reported on the employee's wage statement, the W-2. Instead, it's reported as an expense on the employer's return. So for a business taxed as an S-Corp, the employer's return is the 1120S. So specifically, those employer contributions will go on line 17 of the Form 1120S. Now, since the Secure Act 2.0, if you have a plan like ours that allows it, employer contributions can be made as Roth contributions. Historically, those employer contributions could only be made as pre-tax contributions, so deductible contributions, right? So now, Secure Act 2.0 allows those employer contributions to be made as Roth contributions. So when that rule was enacted with Secure Act 2.0, there was an open question of how do I report those employer contributions made as Roth contributions? And the question wasn't answered until almost a year later when the IRS issued Notice 2024-2, which clarifies that even employer contributions made as Roth contributions still need to be reported as deductible expenses on the employer's return. And then they're going to be reported as taxable income to the employee on a Form 1099-R. So per IRS Notice 2024-2, those employer contributions made as Roth contributions are reported as tax deductible for the year for which the contribution is made, but taxable to the employee for the year for which the contribution is deposited. So the deadline to make contributions for a solo 401k is the business tax return deadline, including any timely filed extension. So that means that there are many individuals right now, for example, in our customer base, that are making 2024 contributions here in 2025. So if someone is making an employer Roth contribution for 2024, but deposited in 2025, per that IRS guidance regarding how to report those employer contributions, it's going to be reported as tax deductible on the 2024 Form 1120S. So it'll go on line 17, but then it'll need to be reported as income for 2025 via 1099-R that'll be issued to the employee. So now the employee will have to add that amount to their 2025 taxable income. They'll have to add it to their 1040. So regardless of whether the employer contribution is made as pre-tax or Roth, it still needs to be reported on the 1120S line 17 for the year for which the contribution is made. But then if that employer contribution was made as a Roth contribution, it'll need to be reported as taxable to the employee for the year of the deposit via Form 1099-R. So we, as an optional free service for customers who request us to do so, we prepare the Form 1099-R as an optional free service. In other words, no additional charge. We have an online form that customers use to provide us the information we need to prepare the 1099-R. So now let's go to the final category of contributions, which is voluntary after-tax contributions. Not all plans allow for voluntary after-tax contributions. Like, for example, the solo 401k plans offered by discount brokerages don't offer plans that allow for voluntary after-tax contributions. But our plan does. And it's one of the top reasons that customers will want to sign up for our plan. And the reason for that is because that's how one makes mega backdoor Roth contributions. So if one is making a mega backdoor Roth contribution, it's really a two-step process, because first they need to deposit those voluntary after-tax solo 401k contributions into a separate voluntary after-tax solo 401k account. And then step two, they move those funds from the voluntary after-tax solo 401k account to a Roth account. They could either move those funds to a Roth solo 401k, or they could even move the funds out of the plan to a Roth IRA. But in response to the question of how do I report those solo 401k contributions, specifically voluntary after-tax contributions for a business taxed as an S corporation, the answer is that one doesn't need to report the contribution, that first step. So voluntary after-tax solo 401k contributions are a type of employee contribution, but they need to be deposited into a separate account. And per the W-2 instructions, it's optional to report those voluntary after-tax contributions on the W-2. So like the Roth employee contributions, those voluntary after-tax contributions are made on an after-tax basis. So they're not going to reduce the income, the taxable income, for the year for which they're being made. In other words, they're made on an after-tax basis. So that's not going to reduce the amount that's in box one, right? Contrast with the pre-tax employee contributions, which are made on a pre-tax basis, which reduce the taxable income for the year for which the contribution is being made. But the W-2 instructions, they say it's optional. So you have the option, but you don't have to. But if one wants to report voluntary after-tax contributions on their W-2, per those W-2 instructions, those voluntary after-tax contributions would be reported on box 14 of the W-2. Now that second step, remember, it's a two-step process. Step one, deposit into the voluntary after-tax account. Step two, move the funds from the voluntary after-tax account to either a Roth solo 401k or a Roth IRA. So while the first step doesn't need to be reported, it's optional to report those voluntary after-tax contributions. The second step, when you move the funds from the after-tax account to the Roth solo 401k or Roth IRA, that is reportable on a 1099-R issued by the plan. And again, we handle that as an optional free service for our customers. In other words, no additional charge. Now, we don't have access to our customers' funds, so customers have to let us know, but we have an online form that customers can use 24/7 to give us the information we need to prepare the 1099-R. So hopefully that helps break down and answer that important question of how do I report solo 401k contributions for a business taxed as an S corporation. We appreciate you joining. If you found this helpful, please like this video on YouTube. Please subscribe to our channel so you get notifications. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again in our afternoon session, 1 p.m. Pacific, 4 p.m. Eastern. It's always free to join. All are welcome. We also have our community. We have a vibrant community with over 30,000 members. We have active forums. It's a great place to learn, to share the knowledge, to see what other folks are asking about. If you want to access our schedule, just come to mysolo401k.net/webinar. So if you go to the webinar page, you can enter your email and then you can get a link to the recording after we're done. Otherwise, just subscribe to the YouTube channel and you'll be able to access it there also. All right, so now let's go to the questions. Thank you for bringing the question. We always, of course, appreciate the opportunity to discuss these topics. If we've already paid $69,000 in W-2 income, why do we need to file a 1099-R for the employer contribution to expense it? Would that already be expensed as salary? Yes, the W-2 income would be expensed as salary, but let's assume that you have $69,000 of W-2 income and the individual wants to make a $10,000 employer contribution. They can contribute up to 25% of their W-2 wages as an employer contribution. But let's assume they want to do $10,000 as an employer contribution. So that employer contribution is going to be tax deductible, but it doesn't reduce box 1 of their W-2. So let's assume that's the only contribution that the individual makes is the $10,000 employer contribution. So that means from their self-employed business tax as an S-Corp, they receive $69,000 of W-2 wages, $69,000 in box 1. So they have $69,000 of income to report on their 1040. But if they're making that employer contribution, it still needs to be tax deductible. So the point being is that it doesn't reduce the wages that the person receives as an employee from their self-employed business. Instead, it reduces the owner income that they receive from that S-Corp. Because when that S-Corp reports that $10,000 employer contribution, it'll reduce the income at the S-Corp level that'll ultimately flow through to the individual as the owner of the S-Corp. So they really have two roles with respect to that S-Corp, right? The individual is the employee. They get W-2 wages. They also get income that's passing through to them as the owner of the S-Corp. So that $10,000 employer contribution will be deductible at the owner income level. The income, in other words, that comes through, that passes through the S-Corp to the individual as the owner of the S-Corp. So it's not going to be double counted, in other words. Good question. That's a great question. Well, again, thank you so much for joining. Please continue to participate. We'll be back tomorrow with some great content. We're going to talk about, in the morning, of course, it's always an open session. You can bring comments or questions, topics to discuss. Then in the morning, we're going to talk about the best self-directed 401k for both traditional and alternative investments. In the afternoon, we'll be back to discuss mega backdoor Roth solo 401k contributions, really an A to Z deep dive discussion. It'll be a longer discussion, more content. It'll be geared towards businesses taxed as a partnership. And then, of course, we'll be back next week with a lot more content. Exactly. So at the S-Corp level, they're going to have $69,000 of expense paid as an employee plus an employer contribution, right? Just like if the business had a third person, so another person that was an employee that was receiving a salary and then also was receiving an employer contribution on top of that to their 401k. Okay, well, wonderful. Until next time, thanks so much, everyone.